November 2022. The crypto world is panicking. FTX has just been exposed as a massive scam. Traders, slapped in the face by reality, are forced to face a brutal truth. A centralized exchange is a black box, where your money is just a number in a database. But back then, decentralized finance for serious traders really wasn't great. It was basically empty, no serious application doing it. Very few options, not enough liquidity, not enough performance. And in the middle of all that chaos, there was a small team of trading experts already preparing something nobody had really dared to build, rebuilding the financial infrastructure of the planet from scratch. And just a few days after FTX, the collapse of FTX, the first test version of Hyperliquid was already live. Today is no longer some small project, it's a war machine generating more fees than Ethereum and Solana combined, close to $200 billion in monthly volume. At its peaks, Hyperliquid captured up to 80% of the on-chain derivative markets, the perps. But let's be careful, because there are also things about Hyperliquid that raise real concern. Is it actually the future of finance or just a kind of centralized company disguised as a blockchain? How can a team of only 11 people manage more than $4 billion TVL? Why isn't there a blockchain open source? And most importantly, what really happened in the JellyJelly scandal when prices were manually adjusted by validators to save Hyperliquid? Today, we're diving deep into Hyperliquid. We're going to talk about the technology, the incredible tokenomics, with 99% of fees used to buy back the token, but also what is more like gray areas. I'm going to talk about how 11 people were able to take so much power over the future of finance in such a short amount of time. Welcome to the house of all finance. Hyperliquid is really contrasting with FTX. After FTX, the market was traumatized. People had just learned that the hard way that trusting a centralized platform meant trusting something you couldn't actually verify. Hyperliquid arrived with the opposite promise: transparent trading, self-custody, and execution that still felt fast enough for serious traders. That's part of why the project took off so quickly. It wasn't just about ideology. It was about building something that could actually compete with CEX's on user experience, which DeFi had struggled to do for years. So first, Jeff Yan, the founder of Hyperliquid. He has a pretty unusual background. He's an American who won a gold medal in the physics Olympiad. He grew up right in the heart of Silicon Valley in Palo Alto. He graduated from Harvard in mathematics and computer science. He learned the ropes at Hudson River Trading, one of the most respected high-frequency trading firms in the world. Hyperliquid has an almost Satoshi-like origin story because unlike 99% of crypto projects, Jeff and his team never raised money from VCs or investment funds. And that matters because it removes the pressure from private investors who usually want to dump their tokens on the community as soon as the token launches. The team is also tiny. We're talking about just 11 people. The revenue per employee is over $50 million. If Hyperliquid were a company, it would probably be the most profitable company in the world per employee. But let's be clear, that tiny team also holds a huge amount of control over the protocol. Jeff Yan is the public face, but there's also a co-founder, Ilian Sink. And honestly, nobody really knows who he is. He's a bit like a Satoshi-like figure too. There's no verifiable public identity. That worries some people, but personally it doesn't bother me. We don't know who Satoshi is either, and that's not a problem. On my own scale, I don't show my face either, and I'm pretty happy staying anonymous, so I get it. So yeah, I think I may have gone a bit too fast. So what exactly is Hyperliquid? Basically, it started as a platform where you could trade perpetual contracts. These are derivatives that were popularized a few years ago by BitMEX. They let you bet on whether a crypto asset or really any asset is going up or down with leverage. Right now, this is what makes the most money for crypto exchanges, even more than spot markets, meaning the markets where you simply buy and sell crypto directly. Hyperliquid started as a perps exchange, but since then it has also launched the spot market for crypto. For users, the advantage of using Hyperliquid is that there is no KYC, know your customers, no account freezes, and above all, you control the funds in your wallets while everything stays transparent. If we go back a bit before Hyperliquid, a lot of decentralized perps were limited by the blockchain they ran on. Hyperliquid made the completely different bet from day one. They decided to build their own blockchain, their own layer 1 from A to Z. It's not just a simple fork. It's not just a basic fork of the Cosmos SDK. They really built from scratch, and they adapted the Libra BFT, the algorithm originally developed by Facebook. Their consensus algorithm is called Hyper BFT. It was optimized for one thing only, on-chain trading. And Hyper BFT is asynchronous. Validators don't wait for some predefined block time to vote. They move forward as soon as enough votes come in. So there is no real minimum duration between blocks. The only real limit is how fast information can propagate between validators. In practical terms, every action feels almost instant. And why is that such a big deal for traders? Because, as I said, you get total transparency. Every order, every cancellation, every liquidation is recorded on-chain in real time. And like on SX, there's no opaque black box that could potentially place secret orders ahead of you and gain an advantage over you, like people suspected Alameda did with the FTX. There's also something called order cancellation prioritization in Hyperliquid. That's something a lot of people don't talk about. On Hyperliquid, canceling an order is prioritized over placing a new taker order. That protects market makers, the people providing liquidity again, and that protect them from toxic flow. And it lets them quote much tighter spreads. In the end, that benefits the average trader too. Without going too deep into the technical weeds, it basically means better prices on a Hyperliquid because the system makes life easier for market makers. And the point about transparency matters a lot because a lot of people think this is really important to have now. On traditional crypto exchanges, a lot happens behind the curtain. You can get front-running concern, privileged internal actors, opaque liquidation systems, and question about whether certain participants get treatment others don't. On Hyperliquid, the promise is that the playing field is much more visible. That doesn't magically remove all risk, but it does remove a lot of the darkness that serious traders hate. The same goes also for the cancellation priority system. Like I said, it's really important. But let's talk about a third point. The third point that is very interesting point about Hyperliquid is that there are no gas fees. When you want to place trades, the mechanism they use is actually pretty smart, and it removes one of the biggest barriers to entry in DeFi trading. Because imagine you're on Ethereum or even on Solana, every action, sending an order, canceling it, making a swap, every action requires gas in the native token. Gas is basically a protection system against spam. If sending messages to the network costs $0, a bot could just fire off billions of orders per second and crash the blockchain. Hyperliquid chose another solution. They call it the fill rate. Hyperliquid was built specifically for trading. The team understood that charging gas, as I said, would make the experience more expensive and more complicated, so they created this fill rate mechanism with just something very clever. The idea is simple. If you're an honest trader, your orders eventually get executed. The fees you pay when a trade actually goes through implicitly cover your use of the network. So instead of charging gas upfront, they assume the trading fees cover the network cost. And to fight spam, if a bot starts sending thousands of orders that never get filled, meaning it has near zero completion rate, then the protocol identifies that behavior as spam, and the bot orders get rejected. So, as I said, the advantage is obvious. No need for the native token. You don't need hype on Hyperliquid just to trade. You can show up with USDC and start trading immediately. That creates a very simple interface that feels a lot like a centralized exchange, such as Binance or Kraken. You can click buy, cancel, do what you want, and it happens instantly without a wallet pop-up appearing every 2 seconds asking you to approve everything again. So as long as you trade normally, the network is effectively free to use from gas perspective, because in the end, it gets paid through transaction fees. Another major milestone for Hyperliquid came in 2025 with the launch of Hyper EVM. It's a layer 1 blockchain compatible with Ethereum smart contracts. It's tightly linked to Hypercore. Hypercore is the original blockchain tied to trading. On Hypercore, they launched the spot market and the perpetual markets. So when people say Hyperliquid, they're often simplifying. Me too. In reality, we're talking about two chains, Hypercore for trading and Hyper EVM for smart contracts. HyperEVM and Hypercore are connected. A lending protocol on HyperEVM can directly read the price of trading pairs on Hypercore and use that as a kind of native oracle. But HyperEVM is still growing and it's still relatively small and not very developed yet. Hypercore is still by far the more mature side, the one bringing in most of the money and most of the users. And that split between Hypercore and HyperEVM is very important to understand. Hypercore is where the exchange logic lives, where the performance is, where the actual trading edge is. HyperEVM is the part meant to attract developers, apps, lending protocols, and the broader smart contract ecosystem. In other words, Hypercore is the engine, and HyperEVM is the expansion layer. That architecture is part of the long-term plan, not just to be a good exchange, but become a full ecosystem where other applications can build directly on top of the trading layer. Now let's talk about the Hype token, because I think that's what a lot of people care about. Most blockchain tokens are basically just used to pay gas fees. They don't really capture the value created by the protocol. Hype is very different. Hyperliquid generates real fees and very large ones. Hyperliquid is currently generating around $700 million in annualized revenue. And the buyback mechanism is honestly crazy. 99% of trading fees are used to buy back Hype. This Hype is bought on the market and it is put in what they call an assistance fund. And unlike a simple buyback, the tokens are effectively treated as burned once they're acquired. That reduces the amount of Hype circulating. And people don't always realize how rare that is. 99% of what a protocol earns going back to token holders. Economically speaking, it's extremely unusual. Yes, it's a buyback and burn, but in practical terms, it acts a lot like dividend distribution. The value of all token rises thanks to those buybacks. Economically, it's similar to a stock buyback in the traditional equity world. Hype has a maximum supply of 1 billion tokens. At launch, 31% of the tokens were distributed through the initial airdrop. And honestly, I think that was one of the biggest wealth transfer in crypto history. It created an enormous number of millionaires among real users of the protocol. I'm telling you, a lot of people made more than $1 million in the Hyperliquid airdrop. And unlike what usually happens when airdrops happen, users show up, farm, dump, and leave, something completely crazy happened with Hyperliquid. The number of active users on Hyperliquid doubled after the token launch, and it has kept climbing. Why? It's because traders actually are there for the product. They genuinely want to use Hyperliquid. It's simply more pleasant to trade on Hyperliquid than on a SEX. No KYC, no account freeze for compliance reasons, none of that. And the token price also rose strongly after the airdrop, whereas in most cases, once again, after an airdrop, the price dumps. That's not what we saw here at all. And this is why the tokenomics get so much attention. Most crypto tokens talk about utility. Very few actually capture real economic value in a meaningful way. Hype, whether people like it or not, has a much more direct connection to protocol revenue than most tokens on the market. That doesn't guarantee success, of course, but it explains why so many investors and traders keep watching it so closely. But how can Hyperliquid conquer all of finance? Well, by becoming the infrastructure on top of which finance gets rebuilt. And one of the best examples of what that is builder codes. Builder codes are, in my opinion, one of the smartest innovations Hyperliquid has introduced. They allow any developer to build a custom interface, a front end on top of Hyperliquid, while using the liquidity already available in Hyperliquid. And the fee logic happens entirely on-chain. Developers can earn a commission up to 0.1% on perpetuals or 1% on spot for every transaction routed through their interface. And the best example of all this is Phantom's integration with Hyperliquid. Phantom, which is the flagship wallet of the Solana ecosystem and has now expanded to other blockchains, integrated builder codes to offer perpetual trading directly inside the Phantom mobile app. That means any user using Phantom can trade on Hyperliquid without even realizing they're using Hyperliquid. And that's pretty incredible, because Phantom handles the user experience. They include a simple bridge system to send SOL and receive USDC, while Hyperliquid handles the trading and the custody logic. And in just a few months, that integration generated massive volume. It made a huge amount of money both for Phantom and for Hyperliquid. MetaMask integrated Hyperliquid in a similar way. Rabi did the same. And what that shows is that Hyperliquid is becoming the backend, the invisible engine of global finance, for global crypto. For now, that's in mostly crypto finance, but I'm going to show you in this video that broader global finance is already starting to move in that direction. So a lot of users are already using Hyperliquid without even knowing it. What's brilliant about this model is that Hyperliquid doesn't need to own every frontend itself. It just needs to own the liquidity layer and the execution layer. If other wallets, apps, and interfaces brings users in, Hyperliquid still wins because the activity still settles to its system. That's the kind of model you see in very strong infrastructure businesses. They become invisible, but everyone ends up depending on them. Another development that shows this transformation of Hyperliquid into an infrastructure layer is HIP3. HIP3 stands for Hyperliquid Improvement Proposal 3, and its official name is Builder Deployed Perpetuals. This is also a huge deal because up until now, it was the Hyperliquid team choosing which assets could be listed on perpetual markets. With HIP3, anyone can deploy their own perpetual market by staking 500,000 HYPE. Yes, that's a lot of money. That's more than $10 million. But the impact is that after HIP3, a large number of real-world assets start showing up on Hyperliquid. Oil, silver, gold, and more. Today, the platform is no longer just a crypto trading venue. It has become the place where traders can trade 24/7. Even when traditional markets are closed, you can trade the oil, silver, and gold. And during the war between the United States and Iran, traders were on Hyperliquid over the weekend trading oil. The numbers are pretty clear. Open interest on HIP3 markets reached a record of up to $1.5 billion. Open interest basically tells you how many positions are open on Hyperliquid at any given moment. HIP3 also generates a lot of money for Hyperliquid. The people who create HIP3 markets, they share revenue with Hyperliquid. So if you create a market tied to oil, for example, you keep half the money generated by that market and send the other half back to the protocol, to Hyperliquid. And on HIP3, one of the main companies launching markets is Trade.xyz. That platform was built by the same people who helped build Units, which provide most of the spot markets on Hyperliquid. And recently, Trade.xyz even secured the official license to list S&P 500 perpetual contracts on Hyperliquid. Trade.xyz also doesn't have a token right now, but in the Hyperliquid ecosystem, there is clearly a culture around airdrops. So some people are speculating that there could eventually be a Trade.xyz airdrop. Personally, I don't really chase those kind of airdrops. And even on Hyperliquid itself, there are still 40% of HYPE tokens left to distribute. So a lot of people are speculating about another major airdrop with a Hyperliquid airdrop. I'm not sure how interesting that is because a lot of people are already trading there for that reason and generating massive revenue. But yeah, it's something I wanted to say. So yeah, as I was saying, with HIP3, instead of manually listing every asset themselves, Hyperliquid has effectively delegated that task to an army of builders who can list all kinds of things. And this is much more than a simple technological upgrade. It's really the foundation for hosting global finance on Hyperliquid, the basis for an entire financial system built on top of it. So Hyperliquid has the application that generates the fees, and it has the blockchain that captures a huge share of those fees. In terms of fee value capture, it's almost the perfect setup. But there was one area where value was still leaking, was still escaping, and that area was stablecoins. USDC is by far the most used stablecoins on Hyperliquid. But for some time now, Hyperliquid has had its own native stablecoin, USDH. USDH was designed specifically to internalize the revenue that had been leaking to Circle, to the creator of USDC. Because with more than $4 billion in TVL and the treasury yield around 4 to 5%, we're talking about roughly $200 million a year going to Circle instead of ending up inside the Hyperliquid ecosystem. So the goal of USDH is to capture part of that flow. There was a whole selection process to choose who would issue USDH. A lot of names applied, including Paxos, Ethena, Tether, not Tether, sorry. But in the end, Native Markets, a relatively unknown team built specifically to launch the stablecoin, won the validator vote. That triggered criticism, because some people think they were very close to the core team and knew things ahead of time before the vote and before the terms of the stablecoin launch were made public. But in any case, they won and they committed to redirecting 100% of the reserve revenue back into the protocol, 50% for hype buybacks, and 50% to drive USDH adoption across DeFi through incentives and other mechanisms. So again, this is a huge growth lever for Hyperliquid. And if you read between the lines and listen to Jeff Yan in podcasts and interviews, you can feel that they want to move gradually toward payments, toward banks. And USDH looks like a central piece of that strategy. And once you understand that you realize the ambition is much bigger than being a better perp DEX. The real ambition is to become the settlement and execution layer of a huge part of digital trading, while letting others build the user-facing products. That's a very different scale of ambition. It's not just about winning market share from one exchange, it's about becoming the rails. And another major innovation that is coming is HIP-4. HIP-4, officially called Outcome Markets, is one of the most anticipated changes on Hyperliquid because it aims to transform Hyperliquid into an infrastructure capable of hosting almost the full range of global financial instruments. Right now, Hyperliquid is mainly about perps and spot markets. HIP-4 goes much further. It covers non-linear outcomes. Concretely, that means it would allow permissionless deployment of prediction markets, of options, of even insurance products. So in effect, it turns Hyperliquid into kind of an AWS for prediction markets. Just like HIP-3 did for perps, HIP-4 would let third-party build their own Polymarket or Calci-style platform using Hyperliquid as the backend. And on HIP-4, markets will be built around USDH, the native stablecoin. The impacts on valuation could be huge. The leading in this category, like Polymarket or Calci, are reaching valuation around $20 billion. If Hyperliquid managed to capture even part of that, or possibly a lot more, then you can imagine the growth potential and the impact that could have on Hype. At the moment, it's in testnet on Hyperliquid, but this is really the kind of thing that could introduce new ways to trade on Hyperliquid without liquidation and without funding fees. So something quite different from the current model. And it's necessary if Hyperliquid truly wants to host global finance. But honestly, not everything is great about Hyperliquid. If you invest in Hyperliquid, you also need to be aware of the risks. For me, the first one is code opacity. The code running Hyperliquid is closed source. It's not open source. To become a validator, you have to run a binary file provided by Hyperliquid Labs. And that's basically the opposite of what people usually expect in crypto, where everything is open source. The team justifies that by saying they need fast updates and performance optimization before gradually decentralizing the protocol. They say they do plan to open source the code, but there's no date. They'll do it when they feel ready and when they think the code is secure enough. But for a project that wants to become the future of finance and also claims some degree of decentralization, the lack of transparency is a real issue. It prevents any truly independent third-party audits of the core system. I'm not saying no audits were done, maybe some were done privately, but there has been no public security audit of the core code. And this is where the Hyperliquid story becomes more complex. On the one hand, you have one of the most impressive products in crypto. On the other hand, you have a structure that still asks users to trust a lot more than many people in crypto would be comfortable with. That tension is at the center of the whole Hyperliquid debate. Is temporary centralization acceptable if the product is that strong? Or is that exactly how systems become dangerous over time? That's the question. There's also regulatory risk. Hyperliquid offers a very high leverage, 40x, 50x, with no KYC at all. That is the kind of thing that could attract the CFTC. For example, if regulators decided to crack down, it could hit hype hard. It could clearly push the token down a lot. A large share of the volumes come from jurisdictions where regulatory clarity is weak, and even if the platform isn't officially available in the United States, let's be honest, we all know American traders can still find ways around those restrictions, and that's a real regulatory issue. And that's also why Hyperliquid has been doing lobbying in the United States. They recently set up a whole lobbying effort there to participate in the political conversation around all this. There's another issue as well. The dominance of the Hyper Foundation in staking. First of all, we don't even know exactly who is running the Hyper Foundation. It could even be the same people as Hyperliquid Labs. That hasn't been made clear. and the Hyper Foundation controls more than 50% of staked Hype, and more broadly of the voting power around the token. That means they have very significant control over the protocol. In theory, they could halt the blockchain without any real opposition. So you have Hyperliquid Labs controlling the code and being able to put whatever they want in that code, with the whole thing being opaque. And then you have the foundation holding the majority of voting power on the network. So when it comes to decentralization, we are still very, very far from the target. Right now, it is clearly quite centralized. And then there was the JellyJelly incident. Hyperliquid has a vault called HLP, the HLP vault. User can deposit USDC into that vault, and it provides liquidity autonomously on Hyperliquid. And in March 2025, there was an incident that scared a lot of people, the JellyJelly affair. A trader manipulated a small liquid token and forced the HLP vault to absorb several $1 million in losses. To save the system, validators had to vote within minutes to delist the token and effectively set an arbitrary price in order to protect users. That incident raises fundamental questions about the separation of powers. In traditional finance, the exchange and the market maker are separate entities. On Hyperliquid, they're tightly linked. If HLP loses too much money, the protocol steps in and to protect it. It's effective, yes, it helps Hyperliquid survive, yes, but it's not really neutral, and it's not really decentralized either. Since then, Hyperliquid has tried to address those issues through several measures. We'll see whether that really solved the problems or not, but personally, I think some doubts still remain. That's why the JellyJelly incident mattered so much. It wasn't just about weird market event, it exposed what happened when a supposedly neutral system has to choose between purity and survival. And Hyperliquid chose survival, and it's good. But you can argue that was the right decision. Yeah, maybe it was, but once you do that, you also reveal where the real power sits. And markets pay attention to that kind of thing. Then there's the competitive landscape. Hyperliquid has more and more competitors. On one side, you have Aster. Aster, it's backed by CZ's investment fund, and so by the founder of Binance. Aster recently made a very fast push and at times even surpassed Hyperliquid in terms of volume. But be careful, its open interest is much smaller than Hyperliquid's, which suggests there may be a fair amount of wash trading or fake volume on Aster. Still, what Aster is doing is interesting. They're positioning themselves as a privacy alternative to Hyperliquid, letting people place orders without it being easy to trace them back to the person who created the orders. So they add the privacy layer that Hyperliquid does not really have. On the other side, you have Lighter. Lighter is betting on an architecture built around zero-knowledge proofs. Their goal is to offer full verifiability on Ethereum. They also offer zero fees for retail users, which is a very aggressive move aimed at attracting Hyperliquid users. But for now, Hyperliquid still holds a huge advantage in volume, open interest, and also in the strength of its community, which doesn't seem very willing to move elsewhere. Maybe people are also waiting for another airdrop from somewhere in the Hyperliquid ecosystem or from Hyperliquid. So, is Hype cheap around $40? There are several different analyses. Some research suggests fair value might be $32 to $49. That's from Oak Research. Other analysis estimate it could reach $60. But for me, the real Hyperliquid bet is long term. If Hyperliquid truly becomes the infrastructure of global finance, then these numbers are just the beginning. We're not even at 10% of what Hyperliquid could become. So yes, it could go much higher, but that may take time. If we look at Hyperliquid market cap, it's still well below something like BNB, for example. A reasonable target could be BNB or maybe Solana. Hyperliquid is around $10 billion, Solana is around $50 billion, BNB is around $85 billion. That gives you an idea of the scale it could reach just by overtaking the current competition. And that's really why the valuation debate is so intense. If you value Hyperliquid as just another crypto exchange, one set of numbers makes sense. If you value it as a future financial infrastructure layer, then the upside looks completely different. The problem is that the second scenario also depends on a lot of things going right. Execution, decentralization, regulation, product expansion, and competitive defense. So you can absolutely be bullish and still recognize the path is not guaranteed. Another thing that worries some people when it comes to Hyperliquid valuation is unlocks, meaning tokens becoming available to the team. And yes, they do have an enormous amount of token that begin unlocking starting in November. But the good news is that they're not taking everything. For example, in November, they unlocked only a small portion of what they could have accessed. Since then, this has continued in March. For instance, they could have accessed around $10 million in 10 million tokens in March, but they only took 100,000 and 173,000. Now, to be intellectually honest, that does remind me a little bit of Ripple, where Ripple can access more around 1 billion XRP per month, but doesn't use all of it and relock some of it. Hyperliquid has plenty of token, plenty of cash as well, I imagine, but it's still important to keep in mind that there is a massive team token overhang on Hyperliquid. That's why one useful approach is to value Hyperliquid on a fully diluted basis, meaning the total valuation once all tokens are eventually distributed to the team, investors, and the broader ecosystem. Not investors, because there's no investors, but you understand. And on that basis, we're already talking about roughly $37 to $40 billion FDV, depending on whether the price is when the video comes out. So that's really the core idea. There are a lot of positive things around Hyperliquid, but there are also things that generally worry people, especially the unlocks and decentralization. My final view on Hyperliquid is that it's a fascinating project. It's also a bet that they will gradually decentralize over time. And it's a bet that they will go beyond crypto, which is exactly that they've been showing recently with oil, gold, silver, and even things like the S&P 500. So yes, I'm clearly bullish Hyperliquid. I'm telling you openly, it's a position I particularly like, it's a token I like. The decentralization issue does worry me, so it's something I'm watching closely. If over the coming months or years there's no meaningful progress toward decentralization, that's something that would bother me, and I would reassess my view. But as it stands, it remains a pretty incredible protocol. The amount of money it generates, we're talking about several hundred millions of dollars a year, roughly $700 million. So it's just insane for a project where the majority of that value gets redirected back into the protocol, into the token. And the growth potential is enormous, with HIP3 launched just a few months ago and HIP4 on the way with prediction markets and options that could turn Hyperliquid into a competitor to Deribit, for instance, for options. There are also many things happening on Hyperliquid right now. Honestly, I like the team. I've listened to a lot of podcasts, and I simply like Jeffian. I've heard him explain how he sees things, how he thinks, where he wants to take the project. He seems 100% focused on Hyperliquid. He's building the protocol with the token. And with the token he already has earned, he could potentially retire. Even before Hyperliquid, he was already a trader who has made a lot of money. And that's one of the reasons Hyperliquid was able to launch without outside investors. But he keeps working on the project. So yes, I'm very optimistic about Hyperliquid. And that's exactly why I think Hyperliquid is one of the most interesting projects to study right now. Even if you don't buy the token, it sits right at the intersection of everything that matters in crypto today. Product quality, token value capture, decentralization. There's some decentralized concern. There's also some regulatory risk, some infrastructure strategy. So yeah, the long-term question of whether on-chain finance can really compete with traditional financial markets at scale. So yeah, tell me what you think about this. Do you think this is something that can actually be bigger than Binance, for example, or bigger than the New York Stock Exchange? I do believe it's a risky bet. I'm not telling you to go all in on Hyperliquid, not at all. But yeah, I do particularly like the protocol, and I wanted to share my analysis with you and make a dedicated video about Hyperliquid. That's what I wanted to tell you, and I'll see you tomorrow for another video. All right, bye-bye.